Welcome back, ladies and gentlemen. Japan's government bond market is sending a signal that global investors cannot afford to ignore, as long dormant yields are moving in ways that historically precede broader financial stress. And if you are watching silver prices at the same time, the divergence raises uncomfortable questions worth thinking through carefully as this unfolds. This content is for informational and educational purposes only and should not be considered financial advice. For decades, Japan has occupied a unique and often underappreciated position in the global financial system. Its government bond market did not merely reflect domestic conditions, it quietly set the lower boundary for interest rates worldwide. When Japanese government bond yields were anchored near zero, they became the reference point against which risk was priced across borders. This was not theoretical. It shaped how capital moved, how leverage was structured, and how sovereign debt was valued in practice. Japanese bonds functioned as a global liquidity reservoir. Large institutions could borrow cheaply in yen, deploy capital elsewhere, and rely on the assumption that funding costs would remain stable. That assumption underpinned decades of carry trades, suppressed volatility, and encouraged duration risk far beyond Japan itself. When yields are structurally pinned at zero in the world's third largest economy, price discovery elsewhere becomes distorted by comparison. Over time, this dynamic influenced sovereign debt pricing globally. If Japan could sustain extreme debt levels with minimal yields, it implicitly lowered the perceived risk premium for other highly indebted governments. The signal was subtle but persistent. Central banks could manage the long end of the curve indefinitely. Markets adjusted accordingly, often without consciously acknowledging the dependency. What matters now is not Japan in isolation, but the role its bond market plays as a reference system. When that anchor begins to move even modestly, it forces a reassessment of assumptions that have been embedded for years. Funding models, currency hedges, and cross-border asset allocation frameworks were built on the premise that Japanese yields were effectively inert. This is why developments in Japan's bond market resonate globally. They challenge the idea that ultra-low rates are a permanent feature rather than a policy condition. If you're analyzing macro risk through structure rather than headlines, this is less about a single country and more about the stability of the baseline itself. Consider how much of the current system depends on that baseline remaining unquestioned, and share your thoughts or continue the discussion as this story evolves. The apparent stability of Japan's bond market has always been less organic than it appears. Yield curve control did not eliminate risk, it redistributed it over time. By committing to cap yields through persistent intervention, the central bank replaced market-driven price discovery with administered pricing. Volatility was suppressed, but only in the same way a pressure valve delays release rather than removes pressure altogether. Over years, this approach encouraged ever greater debt accumulation. When the marginal cost of borrowing is artificially constrained, fiscal discipline becomes optional rather than mandatory. Japan's debt load grew not because markets demanded it, but because markets were prevented from objecting. The bond market functioned, but more as a utility than a signal. Demographics compounded this fragility. An aging population with shrinking domestic savings gradually reduced the natural buyer base for government bonds. To compensate, the central bank absorbed more issuance, increasing its balance sheet footprint, while further distorting market incentives. The system remained orderly, but increasingly inward-facing, dependent on policy credibility rather than broad participation. This is where sensitivity quietly builds. When yields are pinned for too long, even small adjustments carry outsized consequences. Duration risk accumulates across banks, pension funds, and insurers that structured portfolios under the assumption of rate immobility. A modest rise in yields does not behave modestly in such an environment. It propagates through balance sheets that were never designed for movement. The critical point is that policy success created its own vulnerability. Stability became conditional, not structural. The longer volatility is suppressed, the less resilient the system becomes when it inevitably reappears. This is not a failure of intent, but a predictable outcome of incentives. Understanding this framework matters because it reframes recent bond market behavior as a structural stress response rather than an anomaly. If you find this perspective useful, consider sharing your thoughts or continuing with related analysis as we examine how these pressures express themselves across currencies and hard assets. When yields rise sharply, the first-order interpretation is straightforward. Bond prices are falling. But in a system that has been conditioned to expect stability, the signal embedded in that move carries far more information than the price change itself. Yields do not rise in isolation. They rise when buyers demand compensation for risks they previously ignored or were structurally prevented from pricing. Higher yields translate directly into higher refinancing costs for governments, banks, and institutions that rely on rolling debt rather than retiring it. In most developed markets, this process is uncomfortable but familiar. Debt reprices, budgets adjust, and markets absorb the transition with varying degrees of friction. Japan is different because its system was explicitly designed around the assumption that this repricing would not occur in any meaningful way. For years, Japanese bonds functioned less like tradable instruments and more like policy tools. Price discovery was secondary to control. When yields begin to move in that context, it is not simply a response to inflation expectations or growth forecasts. It raises the question of whether the backstop itself is being tested. Markets are not just repricing risk, they are probing the credibility of the mechanism that suppressed risk in the first place. This is where credibility stress emerges. A sudden move in yields suggests that marginal buyers are no longer confident that intervention alone guarantees stability. Even if absolute yield levels remain low by historical standards, the rate of change matters. In highly leveraged, duration-heavy systems, velocity is often more destabilizing than magnitude. Balance sheets calibrated for near-zero movement react disproportionately to even incremental shifts. Japan's situation also differs because of scale and precedent. It represents the most advanced experiment in sustained monetary intervention across an entire yield curve. If volatility reappears here, it challenges the assumption that such frameworks can be maintained indefinitely without side effects. That does not imply imminent failure, but it does suggest diminishing returns to control. This dynamic reverberates outward. Global investors watch Japan not because they expect immediate contagion, but because it serves as a boundary test. If yields can no longer be reliably contained in the most controlled environment, confidence elsewhere is reassessed quietly, not through headlines, but through positioning and hedging behavior. What matters is not whether yields are high or low, but whether trust in the pricing framework remains intact. Once that trust weakens, markets begin to behave defensively, favoring liquidity, optionality, and assets perceived as less dependent on policy management. Understanding this distinction is essential when evaluating why these moves feel disproportionate to the numbers themselves. If this framework resonates, consider reflecting on how credibility, rather than valuation, drives inflection points in financial systems, and continue the discussion as we examine how these stresses express themselves beyond sovereign bonds. At this stage of the cycle, the challenge facing the Bank of Japan is not a lack of tools, but the diminishing effectiveness and rising cost of using them. Each policy lever still functions mechanically, yet every pull creates pressure elsewhere in the system. This is what policy exhaustion looks like in practice. Choices remain, but none are clean. Defending bond market stability has been the central priority for years. Continued intervention can still suppress yields, but doing so requires absorbing ever larger portions of issuance. That concentrates duration risk on the central bank balance sheet and reinforces the perception that pricing is administrative rather than market-driven. Over time, this erodes confidence among external investors who rely on exit liquidity, even if domestic institutions remain compliant. At the same time, aggressive bond support weakens the currency. A softer yen is not inherently destabilizing, but persistent depreciation changes behavior. Import costs rise, purchasing power declines, and households begin to experience policy trade-offs directly rather than abstractly. Currency weakness also invites speculative pressure, forcing policymakers to consider whether defending the exchange rate is worth the cost of tightening financial conditions at home. Raising rates to support the currency introduces a different set of constraints. Even modest increases ripple quickly through a system built on ultra-low yields. Banks, insurers, and pension funds hold large inventories of long-duration assets purchased under the assumption of stability. Rate normalization improves long-term signaling, but risks short-term balance sheet stress, which can undermine the very confidence policymakers are trying to preserve. These trade-offs are further complicated by capital mobility. Japan is not a closed system. Global investors compare relative returns continuously, and domestic capital can seek higher yields abroad if confidence weakens. Defend bonds too aggressively, and currency pressure intensifies. Support the currency too forcefully, and bond volatility rises. Attempt to balance both, and credibility becomes the scarce resource. What matters here is not the next policy meeting, but the narrowing margin for error. Markets are increasingly sensitive to inconsistency because the policy framework has been stretched over time. When guidance shifts or interventions appear reactive rather than deliberate, participants begin to hedge not against outcomes but against uncertainty itself. Liquidity preference rises and long-term commitments decline. This environment favors cautious institutional behavior. Rather than chasing returns, capital prioritizes optionality. Duration is reduced, exposure becomes conditional, and hedging costs are tolerated as insurance against regime change. None of this requires panic. It emerges gradually as incentives adjust. The Bank of Japan is managing a system where trust has replaced flexibility. Stability depends less on economic fundamentals and more on belief in coordination and control. Once that belief is questioned, even subtly, policy effectiveness declines regardless of intent. Understanding these constraints helps explain why incremental changes in language or action can have outsized effects. They are interpreted not as isolated decisions, but as signals about the limits of control. If this lens is useful, consider continuing with the analysis as we examine how these pressures transmit through currencies, commodities, and alternative stores of value. And share your perspective as the discussion evolves. Rising yields in Japan do not operate in a vacuum. They interact directly with the currency, and through that channel, they influence capital flows far beyond Japan's borders. For years, the yen functioned as a funding currency of last resort. Its stability and low yield made it ideal for carry trades, where capital was borrowed cheaply and deployed into higher-yielding assets elsewhere. This structure was not speculative excess. It was a rational response to persistent policy signals. When Japanese yields begin to rise, even incrementally, that structure starts to strain. Higher domestic yields reduce the incentive to export capital, while increased volatility introduces currency risk that carry strategies are not designed to absorb. As a result, positions that were previously considered low risk begin to look asymmetric. The unwind does not happen all at once, but it rarely happens smoothly. The yen's behavior becomes central here. If yields rise because policy control weakens, the currency can strengthen as capital is repatriated. If yields are capped aggressively, the currency can weaken further, reinforcing inflationary pressure and eroding purchasing power. Both outcomes matter, not because one is inherently better, but because they force market participants to reassess assumptions that had been stable for years. This reassessment drives a feedback loop. As carry trades are reduced, capital flows reverse, affecting assets that had benefited indirectly from cheap yen funding. Equities in developed markets, particularly those sensitive to global liquidity, can experience increased volatility as marginal buyers step back. Commodities, which often reflect both currency dynamics and growth expectations, begin to decouple in uneven ways, with industrial demand and monetary hedging pulling prices in different directions. Emerging markets are especially exposed. Many relied on stable funding conditions and predictable currency relationships to manage external debt. When global capital becomes more selective, funding costs rise and local currencies come under pressure. This does not require a crisis. It reflects a tightening of conditions that were previously taken for granted. The shift is often visible first in bond spreads and forward currency markets rather than spot headlines. What makes this dynamic difficult to manage is its second-order nature. No single participant is driving the change. Instead, institutional behavior adjusts incrementally. Hedging ratios increase, duration exposure is trimmed, liquidity buffers are raised. These decisions are individually rational, but collectively they reduce risk appetite and amplify price sensitivity across markets. This is where volatility migrates. It does not remain confined to Japanese bonds or the yen. It expresses itself where positioning was most crowded and assumptions were most uniform. Assets that depended on stable correlations begin to behave unpredictably. Models calibrated to low volatility regimes struggle, not because the inputs are wrong, but because the regime itself is shifting. From a structural perspective, this is less about stress and more about repricing optionality. Capital becomes more cautious when the cost of being wrong rises. In that environment, markets place a premium on liquidity and transparency. Assets perceived as heavily intermediated or policy-dependent are discounted, while those with clearer settlement, ownership, or supply constraints are evaluated differently. None of this implies inevitability or collapse. These are probability-weighted adjustments, unfolding over time. The system is adapting to a change in reference conditions, not breaking. But adaptation carries friction, and that friction shows up as volatility across asset classes that were previously insulated by global liquidity. Understanding this currency and capital flow linkage helps explain why seemingly localized developments resonate globally. Japan's role is not dominant because of size alone, but because of how deeply its policies were embedded in the financial architecture. When that architecture shifts, even slightly, the effects propagate through incentives rather than headlines. As this process continues, it becomes increasingly important to watch behavior rather than commentary. Where capital hesitates, where hedging intensifies, and where price discovery begins to reassert itself. If this framework adds value to your analysis, consider sharing your perspective or continuing with related discussions as we examine how these flows intersect with commodities and alternative stores of value. Silver's behavior in the current environment stands out not because it guarantees any particular outcome, but because it reflects a different set of incentives than most traditional risk assets. Its recent strength should be viewed as a signal embedded in market structure rather than a directional forecast. Unlike equities or sovereign bonds, silver sits at the intersection of industrial demand and monetary psychology, which allows it to respond to stress in ways that are often misunderstood. On one side, silver is a critical industrial input. It is embedded in supply chains tied to energy transition, electronics, and advanced manufacturing. This creates a baseline level of physical demand that is less sensitive to short-term financial conditions and more tied to long-cycle capital investment. When real yields move or currency relationships shift, that demand does not disappear. It adjusts slowly, anchored by physical necessity rather than portfolio allocation. On the other side, silver carries a monetary history that reasserts itself during periods of sovereign stress and policy uncertainty. It is not a currency, but it functions as a reference asset when confidence in administered pricing weakens. This is particularly relevant when bond markets exhibit instability and central bank credibility is questioned. In those moments, silver is evaluated less on growth expectations and more on its role outside the credit system. This duality explains why silver often decouples from broader risk assets. During equity drawdowns, driven by liquidity tightening, silver can underperform. But when stress originates in the bond or currency complex, its behavior shifts. The market begins to differentiate between paper claims and physical settlement. Futures prices may lag or become volatile, while physical premiums reflect tighter availability and delivery preferences. This divergence is not speculative. It reflects how participants prioritize access over leverage. Institutional behavior reinforces this pattern. Large allocators rarely treat silver as a tactical trade during calm periods. It becomes relevant when hedging frameworks change, particularly when duration risk and currency exposure become harder to offset with traditional instruments. In that context, silver is not replacing bonds or cash. It is complementing them as a form of optionality. What matters here is not the absolute price level, but the message embedded in relative performance. When silver strengthens, while real yields rise and risk assets struggle, it suggests that markets are not simply chasing inflation hedges. They are reassessing trust in financial intermediation. Assets with fewer layers of counterparty dependency are evaluated differently when policy paths become less predictable. It is also important to separate narrative from mechanism. Silver does not move because of headlines about crisis. It moves when incentives align, when holding long-duration paper assets feels asymmetric, when currency hedges become expensive, and when physical ownership carries perceived value. These conditions emerge gradually, often before they are widely discussed. Viewed through this lens, silver's behavior is less about speculation and more about stress diagnostics. It highlights where confidence is thinning and where markets seek alternatives that sit partially outside the policy framework. This does not imply inevitability, but it does offer insight into how participants are positioning for uncertainty rather than forecasting outcomes. As we continue to examine these signals, the focus should remain on structure and behavior rather than price targets. If this perspective resonates, consider continuing with the analysis or sharing your observations on how precious metals fit into broader shifts in trust and credibility across financial systems. There is a point in every heavily managed system where the discussion quietly shifts. It moves from debating whether policy tools are sufficient to asking whether the framework itself is still trusted. This transition rarely announces itself through dramatic price moves. More often, it appears in how markets respond to volatility rather than to data. When bond volatility becomes persistent rather than episodic, it stops being a byproduct and starts becoming the risk. At that confidence threshold, price discovery reasserts itself in uneven ways. Bonds, which are supposed to anchor valuation across the system, begin to transmit uncertainty instead of absorbing it. Yield movements no longer communicate macro expectations alone. They signal doubts about control, coordination, and the limits of intervention. Once that happens, other asset classes are forced to reprice, not because fundamentals changed overnight, but because the reference point they relied on is no longer stable. Currencies react first. Exchange rates adjust to reflect not just interest rate differentials, but credibility differentials. Hedging costs rise as volatility increases, and participants become more selective about exposure. Capital flows respond accordingly, favoring flexibility over yield. This is not capital flight. It is risk management adapting to a shifting regime. Metals respond differently. Gold and silver are not pricing policy failure. They are pricing optionality. When confidence in administered markets weakens, assets with fewer layers of intermediation are evaluated through a different lens. This often shows up as divergence between paper pricing and physical demand. Premiums, delivery preferences, and inventory drawdowns matter more than spot quotes because they reflect behavior rather than sentiment. Long-duration assets face the most pressure. Their valuations are built on assumptions about stability, predictability, and discount rates that extend far into the future. When bond volatility rises, those assumptions become fragile. Even small changes in required return can materially alter perceived value, prompting gradual repricing rather than abrupt liquidation. The key insight at this stage is that markets are no longer focused on outcomes, but on resilience. Participants are asking which structures can tolerate uncertainty and which depend on continuous confidence. The shift is subtle, but it reshapes behavior across portfolios. Exposure becomes conditional, leverage is reduced, and liquidity is treated as an asset rather than a convenience. Importantly, this is not a moment of collapse. It is a moment of reassessment. Systems do not fail because confidence wavers. They fail when incentives prevent adaptation. What we are observing instead is a recalibration, driven by the recognition that volatility itself carries information. Understanding this confidence threshold helps frame why recent moves feel disproportionate to the data that supposedly triggered them. Markets are not overreacting. They are repricing trust. If this framework aligns with your own observations, consider continuing with the discussion or sharing how you see credibility evolving across bonds, currencies, and real assets as this cycle develops. Stepping back from the individual markets and mechanisms, the broader picture becomes clearer. What is unfolding in Japan's bond market is not a localized breakdown or a sudden loss of control. It is better understood as a stress test revealing the structural limits of systems that rely heavily on debt, coordination, and sustained confidence. Japan simply happens to be the most advanced example, not an outlier. Debt-driven systems function as long as refinancing remains predictable and trust in policy management stays intact. For decades, that trust allowed governments and institutions to extend duration, increase leverage, and treat volatility as an anomaly rather than a feature. The recent behavior in bonds challenges that assumption, not by breaking the system, but by reminding participants that stability is conditional. Volatility, in this context, is not an enemy. It is information. It exposes where incentives are misaligned and where buffers are thinner than models suggest. When volatility rises in sovereign debt, it forces reassessment across portfolios that were constructed under the premise of rate immobility. This reassessment is uneven and often uncomfortable, but it is not synonymous with collapse. Importantly, Japan's experience highlights a global constraint rather than a national one. Other developed economies operate under similar dynamics, even if the timelines differ. High debt loads, aging demographics, and reliance on central bank balance sheets are not unique features. What differs is how close each system is to its credibility threshold. Japan's role is to illuminate the path, not to predict the destination. From this perspective, the more immediate risk is misinterpretation. Framing these developments as imminent failure encourages reactive behavior, while dismissing them as noise ignores structural signals. The more productive approach is to understand how volatility reshapes incentives. Capital becomes more selective, duration is questioned, liquidity is repriced. These shifts happen gradually, often beneath the surface. Assets and strategies that depend on continuous policy suppression of risk become more fragile in such an environment. Conversely, those that tolerate uncertainty or operate with fewer layers of intermediation are evaluated differently. This does not imply wholesale rotation, but it does suggest a recalibration of expectations around stability and return. The key takeaway is that systems rarely fail suddenly. They adapt under pressure. The adaptation process is where opportunity and risk coexist. Recognizing volatility as a signal rather than a threat allows for more measured decision-making and reduces the temptation to extrapolate extremes. As this macro adjustment continues, the focus should remain on structure, incentives, and behavior rather than short-term narratives. If this synthesis adds clarity to your own analysis, consider continuing with the discussion or sharing how you interpret the broader implications as global markets navigate the limits of debt-driven stability. As this cycle develops, the most useful discipline is synthesis rather than reaction. Sovereign debt dynamics, real yields, and hard asset behavior are not separate stories. They are reflections of the same underlying question about trust and structure. Watching how these signals align or diverge offers more insight than any single data release. This is an environment that rewards patience and critical thinking over certainty. If you find value in this approach, consider sharing your perspective in the comments or continuing with related analysis as this macro narrative evolves.